This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, and Bloomberg Originals.
Very good afternoon, everyone, and happy Fed Decision Day. It is Wednesday, June 17th. I'm Christina Ruffini here with Emily Griffeo. Carol and Tim are on assignment, but we've got you covered. We've been watching this all afternoon. Obviously, the first remarks we've heard from Kevin Warsh in this job. What stood out to you, Emily?
Well, first of all, the remarks were shorter than we usually expect, particularly
written and verbal remarks. Yes, they're both shorter.
Yeah, I mean, that's definitely what stood out to me, Christina. And I think the markets are actually reacting perhaps more than I would have expected, particularly in the bond market. The two-year yield is now up 16 basis points to 4.2%. Certainly the market telling us that this was a more hawkish message than maybe some had expected. And stocks also, just in the last 10 minutes of trading, down in the red. The S&P 500 down about 1%.
All right, we're going to dig all into that shortly, but first, let's play some sound from Kevin Warsh's first time at the big podium.
Persistently high prices are a burden for the American people. But the recent past need not be prologue. I am pleased to report that members of the FOMC are unambiguous and unanimous. This committee will deliver price stability. You might have already noticed something, a difference in today's policy statement. It's a bit shorter, a bit simpler, and it dispenses with some older language. That statement just gives you the facts as best we can judge it. Absent also is so-called forward guidance, which we agreed was not well suited to the current policy conjuncture.
And that was Fed Chair Kevin Warsh at today's press conference. Following the paper statement, we saw two-year yields spike sharply, and now we're seeing that move continued again, 16 basis points higher on the two-year. The next FOMC decision, July 29th, Christina. So we'll be waiting for that.
Not that long away, yeah.
And we'll probably not get a lot of communication from the Fed in between, as this is a Fed that is committed to easing back that forward guidance and that communication.
But we did learn there's going to be a task force about the communications. So
we are going to ask our next guest about all of this. With more on today's Fed decision and market reaction, let's bring in Yelena Shulyatyeva, senior U.S. economist at the Conference Board, joining us right here in person. Let's just get your initial reaction to what we saw today.
A task force for everything, right? So that was my initial reaction. Well, actually, today brings back memories when young Yelena started covering, started looking at the Fed under Chairman Greenspan. So like shorter statement, sharper communication. And I think that it means something by itself. Obviously, this is something we expected from the meeting today, like a revamp of communication in particular, right? So I think we're going to get some revamp in terms of the dot plot. That will probably go. We don't know that. There's a task force for that. But there were some unexpected things today as well. So some expected stuff and some unexpected. Unexpected part was how hawkish the committee was, right? The number of people who actually wanted to see rate hikes this year, the recommitment to the inflation. It was half. 9 out of 18 who submitted the dots, and the recommitment to the inflation side of the mandate on top of a higher forecast for core inflation today.
How significant do you think it is that Warsh, when you saw the dots, there was one missing and everyone kind of assumed it was him, and then he confirmed that in his remarks. And he said he just doesn't think, these forecasts are helpful right now given how uncertain everything is. Does he have a point, or do you think how significant is it that we didn't have a Warsh dot?
The dot plot has been a very interesting thing well before Warsh started. So I know a lot of people had different opinions about that, and a lot of people wanted to get rid of it. And so it's not an easy answer. Actually, I think it's a good thing that we will get that task force looking at different types of communications. Some things were great during the financial crisis. Some things were great during the COVID crisis. how we're doing it now, what should be the approach, I think that's probably has been long overdue.
I think it's interesting because he was asked, I think by Mike McKee, if he was anti-press conference. And he said, no, actually. He said, press conferences are, quote, a very useful way to communicate, but they need to have something to say.
Which probably means not a press conference after each and every meeting. So that how I read that statement. But we will see. Probably they will continue, at least this year, until that review is done. We will continue to hear from him at each and every conference.
How do you think the task forces are going to contribute to consensus at the Fed, or a lack of consensus? It just seems like it's going to introduce more cooks in the kitchen, essentially.
Well, we are very much used to the cacophony of different, opinions on the Fed. I think it's a good thing. I think, people expressing their own views is an absolutely great thing. And I think that should continue. So actually, this is one of the things that I'm very concerned about, that there will be some limitation of how much you can actually express your views. I don't know in practice if that could be done, but I think that, the transparency introduced during the financial crisis was one of the biggest achievements of this Fed.
When it comes to these committees, do you think they also give Warsh a bit of cover from the president, where he can say, look, I am remaking it, I'm taking a look at the institution, we're doing it, but whatever the conclusions of these working groups are, he can then point to them and say, well, this is what they decided, and the decision is less on him?
Let me tell you something. I think it's a good time to review a lot of things, because the economy is giving us a good gift right now. So you don't really have to do anything in terms of interest rates right now. So probably now is really a good time to do all these reviews.
When you just think about the message that we got from the Fed today, and also the market reaction, do you think the Fed is viewing inflationary pressures as temporary? I hate to use the word transitory, but temporary.
They used a supply shock language in the statement, right? So that tells me that this is kind of the idea, that they are viewing it as a temporary thing. And, the omission of the labor market mandate mentioned in the statement is not necessarily, saying, oh, we are more focused on the inflation mandate. They actually reaffirmed the dual mandate language in the statement. In that short statement, they managed to do that. I think that, they will pay a lot of attention to inflation right now, but they will continue to be balanced going forward.
But this idea that, half of the people at the Fed are saying we'll get a hike.
They're split right now. And the data, well, whether he wants to pay attention to the data or not, or the quality of this data, but they have to do that. And the data will eventually tell us whether this is a temporary shock or not.
We've got about a minute left, but on that split, this meeting was a little bit good for him, right? Because there was unanimous consensus on to leave rates. When you get to the next meeting, you start to see that split. Is it going to be harder for him to project leadership? Is he going to have to do a little bit of, as he mentioned, family meetings or family fights? Is it going to be difficult to hold that consensus together?
I think that a lot of different people on the committee have a lot of different opinions. It's very good to see that consensus building in the first meeting, and it was actually very good to see. But you're right, we could see some dissents going forward. I will not be surprised.
Did you think that you were going to hear the word task force that many times in the first press conference?
That was probably another unexpected thing, on top of the how hawkish they were today.
All right. Yelena Shulyatyeva, thank you so much, senior U.S. economist at the Conference Board. Emily, to your point, the markets did have a really sharp reaction, and I was surprised to see that bond reaction. We're going to come back after the break and talk more about that.
Yeah, it's a big day in markets, one of the biggest market reaction days we've seen on a Fed day in quite some time here. So it'll be interesting to see if the move holds, Christine. Again, just taking a look at S&P 500, finishing this market day down about 1.3%. If you're sticking with us, we're coming back in just a few minutes. This is Bloomberg Businessweek Daily.
It's 3:58 on Wall Street. We do check markets all day long here at Bloomberg. The Dow, the S&P, NASDAQ all declined on this Fed Wednesday with a 10-year at 4.48%, a 2-year 4.20%, and the 30-year 4.92%. Traders sending stocks lower. Short-dated bond yields climbed after the Fed signaled the possibility of higher rates as it assesses the impacts of the Iran war on inflation. Reaction to Kevin Warsh's news conference and the Fed move today from Kate Moore. She is the Chief Investment Officer for Wealth at Citigroup Global Markets.
There was broad acknowledgement that the economy is in good shape. There's also broad acknowledgement that the rates, as they currently stand, are not actually restricting any major sector outside, of course, housing, which Warsh mentioned. And there was a lot of collegial talk about how well the Fed is working together, how well they're communicating, how welcoming Warsh felt, in his new chair position. So there was actually kind of a positive tone about both the economy and the functioning of the institution.
Kate Moore of Citigroup Global Markets. So the Dow, the S&P, NASDAQ all wrapped up this Fed Wednesday in the red. S&P at 7417, tumbling 92 points, just about the low of the day, down 1.2%. Dow Industrials down 530 points today. That's a decline ahead of the closing bell, down by 1%. NASDAQ Composite Index down 361. For NASDAQ, a drop there of 1.4%. The NASDAQ 100 Index lower today by 1%. Again, the 10-year 4.49%, with the 2-year at 4.21%. Spot gold, $42.35 the ounce, lower by 2.2%. West Texas Intermediate crude, $75.96 a barrel, down today by 0.1%. Barrel of Brent, $78.90, a drop today of 0.1%. And there you have it, sound of the closing bell at the New York Stock Exchange. Folks from Hovnanian Enterprises ringing that closing bell. Recapping, S&P down 91, drop there of 1.2%. Day 4 for trading of SpaceX, and the stock fell today by roughly 5%. Lazy Boy shares jumped today by 14.8% after the home furniture stores reported adjusted EPS for the fourth quarter beat the average analyst estimate. Again, Lazy Boy today up by 14.8%. Fed Wednesday, 10-year 4.49%. The S&P 500 index down by 1.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, and Bloomberg Originals.
And welcome to Bloomberg Businessweek Daily. I'm Emily Grafeo, here with Christina Ruffini.
Hey, girl, hey.
Of our weekend show, but it is not the weekend. It is a Wednesday.
It is, and it is Fed Day. So happy Fed Day to us all. We had the premiere of the podium of Kevin Warsh announcing many things. And, as you've been talking about, the markets have reacted pretty sharply, which surprises me a bit because I thought this was kind of where we thought this was going. But you were saying maybe more as the projections looking forward, people are really starting to price in that there's going to be a hike towards the end of the year.
Yeah, we're going to talk about markets in just a moment here, but you look at the reaction. The 2-year yield up 16 basis points. Certainly, my read is that it was more hawkish than we had expected. And of course, we have a unanimous decision again to leave rates unchanged today.
That's right.
But looking forward.
I did enjoy your read, but let's get a read from our other two guests. We've got Stuart Paul. He's Bloomberg Economics U.S. and Canada economist, and Andrew Szczurowski. He's Strategic Income Portfolio Manager, I can say that word, I promise, manager at Morgan Stanley Investment Management. Thank you both for joining us. All right, who wants to take it first? What were your initial impressions? Were we surprised, not surprised?
Well, I'll jump in. Look, I expected Kevin Warsh to come out swinging, to be rather hawkish. So that's when the first thing that we saw was the FOMC statement. I was actually a little bit surprised. Most of the text of the FOMC statement, at least on my read, was rather dovish. He was focusing, or I should say the committee itself was focusing on supply side factors that are contributing to inflation. The committee was focused on the fact that the labor market is relatively, unchanged.
Yeah.
It was not saying that there's any progress or any strength in the labor market, for example. The one hawkish line in the statement is just that the Fed is committed to its 2% inflation target, basically. So that took me a little bit by surprise, but the dots really do all the talking that we needed to see today.
The ones that are there.
That's right. The dots that we received today spoke volumes, said far more than the FOMC statement really ever could. And obviously that's what markets are indexing on.
Andrew?
Yeah, it was certainly a very hawkish dot plot and certainly a very hawkish press conference. I guess the question for markets is still, is this a lot of bark so you don't actually have to bite later? Basically, are you trying to tighten financial conditions now? Are you trying to threaten with rate hikes, which you know will ultimately combat inflation more than if you come out and say, and it also gives you credibility. This is your first press conference. You need to come in. You don't want to seem like a puppet of the administration, so you come out and you talk extremely hawkishly. Are you going to follow through on it? That's still to be determined, but I think you did your job in the first press conference by giving yourself some credibility. Now we'll see. Again, 6 weeks from now, are you still going to be talking this way? I think right now it's easy to talk, and obviously risk assets are kind of falling on this news. But I'd like to see if they actually follow through.
The reaction in the front end of the bond market, 16 basis points higher on the 2-year. Does that surprise you, and do you think that holds?
Yeah, no, it certainly surprises me because I wasn't expecting there to be 8, 9 FOMC members who were projecting a hike as the next move. And there was talk of 3 or 4. And so I think that's where the big surprise was. And look, as a bond investor now, you have to kind of increase that probability that is the next move. Again, this is a very divided Fed. You can see that with half the committee thinking hikes and half the committee thinking cuts, like there's not very often that we're at that place. And so I think that time will tell. I do think that there's some tailwinds that are going to help new chair Warsh, which is, look, oil's just fallen $35. 6 weeks from now, when we get a couple CPIs, that things could be going your direction where headlines coming down because gas prices, oil. And so you can say this now, and then look, you have some time to kind of figure it out without actually hiking.
Although we did see a little bit of shakiness after the president said if Iran doesn't agree to those terms, that he's going to go back to bombing them again. We did see that reflected in the markets and in Brent and WTI a little bit this afternoon. Stuart, Warsh also said there was limited discussion about a rate cut today with one proposal. Do we think that was his proposal? Do we think he was a limited discussion?
No, I don't think that he was offering anything in terms of cuts. When his real opportunity today was behind that pulpit. It was behind that podium, using the bully pulpit to his best advantage. And he put basically no emphasis on the labor market at all. Anytime he brought up the remit from Congress, he did not bring up a dual mandate. He focused entirely on price stability. So I don't think that any of the discussion around the table by anyone with regard to cuts was being encouraged by Kevin Warsh today. I think that we saw pretty vintage Kevin Warsh behind the podium, and I imagine that he was the same way in the room. What I'm a little bit interested in, and Christina, this is to your point, we have seen energy prices coming down pretty substantially. Andrew, you mentioned this as well. When we see the move in markets following both the FOMC decision and the press conference, we saw long-term rates floating up a little bit, but we saw break-evens falling. So literally throughout the entire curve, they're viewing this as hawkish, but not necessarily hawkish on I guess just real rates are still rising throughout the curve. Is this indicative of just some sort of a regime change everywhere? I mean, I'm interested to hear your thoughts, Andrew.
No, it's a good question. I think one of the things for the bond market for real yields is that when you talking about the amount of communication we're going to get from the Fed, it seems like if they're going to be less communicative, then volatility is going to be higher. But I think that Chair Warsh's sole focus on inflation, and this is like inflation's a choice, all these things should certainly be, compress break evens and give bond investors the confidence, look, short-term pain, long-term gain as far as where yields can go. If you basically can speak hawkish now and say you're going to combat inflation, that's good ultimately. And you're obviously seeing it in the 30-year where yields are actually down despite the move in the front end. Like this is one of the biggest flattening days we've seen in some time. I think that break evens are ultimately going to follow oil in the short term. If this truce with Iran is longer lasting, then I think you'll continue to see break evens come down. And again, they've come down 50, 60 basis points at the front end just in the last month or so, and that's all related to oil. And I think that I don't think we have that big of an inflation problem if the war in Iran is over and oil is going to resume its kind of, March. Yeah. So it's a big if. Exactly. It's a big if. And I think this would have been a much tougher meeting for Chair Warsh 4 weeks ago, when all of a sudden oil was at 110, 115. Yeah. I think that's a situation where, we didn't know if oil was going to 150 next or 200. The Strait of Hormuz is still closed, but oil's at $75, $76. I think it's easy to talk like this now. This could have been a much tougher meeting just a few weeks ago.
When you look at their approach, and Warsh saying that he's likely going to be less communicative, and you have all these, what are they not, working group, task force, so many task force, to talk about the communication. Is there a risk, and one of our colleagues posed this question, but is there a risk that if the Fed, to your point, is communicating less in a time of market volatility, that silence is going to get filled somewhere, and they could lose track of the narrative and almost be less influential if other people are filling that void that they would expect the chair to fill?
I'm not entirely that worried. From a monetary policy making perspective, communications as a tool for conducting monetary policy is asymmetric. It's really valuable if you're constrained by the zero lower bound and you're trying to talk down the curve. You're trying to give some sort of a credible commitment that you will not raise rates. Instead, we're in this moment where risk is somewhat two-sided. Policymakers are divided on whether they want to stay still at least through this year and then deliver some sort of a cut or hike before year end. And when that's the case, offering any sort of forward guidance is just unnecessary hand binding by the Fed. And so I'm not sure they're entirely worried about losing control over the narrative. Instead, I think that at least it sounds like from Kevin Warsh, it's a good thing to remove oneself from crafting the narrative, to let markets digest information as it becomes available, and the Fed will deliver the policy that it thinks is necessary and appropriate. And the objective of guiding markets' expectations is less valuable than establishing, let's say, independence, both from the market and from political pressures.
Andrew, what do you think? Because you're someone in the markets. How are you going to, is there an information void now? And if you think there is, how are you going to determine the path of Fed policy ahead if you have that lack of guidance? Are there other signals you're going to pay more attention to?
No, look, I think you'll read more of the speeches that are kind of intra-meeting and see what different FOMC members are saying. I think Stuart makes a great point where a lot of times the Fed is talking for the sake of talking, but you don't have much to say. It's like if we're on a pause for 6 or 12 months and you're just doing this press conference, I do think it's going to be tough to kind of walk it backwards, and then just what are you going to have, like an impromptu press conference every time you hike or cut? It's going to be tough to keep those things quiet, and there's always things that are going to kind of leak through the system. So I think that it's something that markets crave information, and as you were saying earlier, like there's going to be, if there is some information void, people are going to look to somewhere else. Again, there's a task force. We'll see, if the task force ultimately decides this is in the best interest, then maybe we keep them. I think that, are you going to go to every other meeting? Is it going to be, what are you going to do if not, at every meeting? It's kind of, obviously we used to be there, but I think that it ultimately may end up staying in the long run, but we'll see.
So to clarify, I just want to recap because we haven't actually said it. So in his prepared remarks, he announced 4 task force, one on communications, one on the Fed's balance sheet, one on the use and reliance of existing data sources, and one on productivity and jobs. So I'm sorry, you were going to say something.
Well, it's interesting that you bring up the idea that, yes, there are all these task force that are going to be rolled out to perhaps offer some additional information.
Yes, if you had prepped a Kevin Warsh Fed drinking game and task force had been on it, we would all be in very bad shape right now.
That's right. Task force was where price stability would have been another,
correct.
Would have been on the bingo card also. So we're going to get some additional information from these task force. Andrew, to your point, that in the absence of formal communications from the FOMC, markets are going to be looking for that information elsewhere. The thing that I'm a little bit hung up on is that maybe that information doesn't come from a person. Maybe we go back to circumstances where that information is provided by the data. That information is provided by evolving global conditions. And I think that that's something that would definitely be welcomed by the Fed. But where that intersects with these task force is interesting. If you don't entirely know where the Fed is looking for its inflation information, because that's evolving with these task forces, that
is it like Attorneys General Task Force? Anyway, continue.
Yeah.
Yes,
it becomes a little bit more complicated to get any sort of insight into the Fed's reaction function or guidance for policy. I think that instead we're going to need to work the other way. As economists, at least in my seat, we're going to need to work the other way. As markets evolve, as the data evolves, what are we thinking about the intersection of, let's say, markets and the real economy? So over the last several months, we've seen some tightening of financial conditions in the form of higher rates, and we have at least thought that those higher rates would do some of the heavy lifting for the Fed. The Fed wouldn't necessarily need to deliver cuts because we've already seen some of the move in markets, and that would restrain economic activity. And so it seems like that would be a way that we might have to consider both economic evolution going forward and financial markets evolving going forward.
Andrew, were you at all concerned? I don't know. I guess I've covered Washington long enough. I always think of that, if you torture the numbers long enough, they will confess adage. And when I heard them doing a task force into, quote, the use and reliance on existing data sources, any concern there that lends itself to manipulation if that were to be changed too drastically?
And Chair Warsh has spoken before he came into office about some of the inaccuracies in the inflation data. Not inaccuracies, just some of the quirks with the inflation data. When you look at using OER for housing instead of some other metrics where you have Zillow rent index, which is showing one handle year-over-year inflation in rents, and apartment list is showing negative, but owner's equivalent rent is showing 3.5. So I think some of these things are a way to actually, show that the inflation number is actually lower. There's metrics out there like Trueflation and stuff that are showing a much different inflation picture, but we know we do have an inflation problem right now. My view is that it's just solely reliant on the move in oil, and if oil's coming down, then it'll solve itself. And that, as Stuart mentioned earlier, like this is not a demand-driven oil shock. This is a supply shock. The central banks, the Fed historically doesn't respond to those. Obviously, the ECB did. And if every other central bank in the world does respond to that too, ultimately you might have a weaker dollar and then inflation's going up. So that can actually cause more inflation too. But I think that it's something over time. We're going to see some changes to the inflation data. I think some of that's welcome, though. I think some of it's a little bit archaic. We have more real-time data sources we can be using. So I think that's something that markets would welcome.
You follow the housing market as well, and there was some talk today about the transmission mechanism and the transmission of monetary policy. Do you think that we're in a restrictive world where these higher rates that we've now seen for a couple of years are actually working their way through the real economy?
Yeah, look, the one area that obviously higher interest rates impacts the most is in the housing market. And you've seen that with home building. You've seen that with home sales. Existing home sales, new home sales are quite depressed. And that's for good reason. Look, there's a lot of people that have these 2.5% to 3.5% mortgages. For them to move into a house that's 50% more expensive in price, but also has kind of doubled the mortgage rate, just doesn't make sense. And so I think you're seeing those people respond accordingly. I think, look, over time, I think there was this view a couple of years ago where I think even like Quicken Loans said something where like buy the home, date the rate. Well, mortgage rates have now been at 6+% now for a number of years in a row, and so I think that's
that's too much dating. You got to commit at some point.
So I think that look, the housing market is weak as it should be. But in the construction business, there's one thing that actually is filling that void a little bit, which is data center construction. So I think that's helping on the construction side fill a void that would typically be there for years until rates came down.
You've led very nicely into my last question, which, Stuart, I'm going to lob over to you. Warsh was actually also asked about AI. And he said it's the most important change in the economy and business we've had in our adult lives. Do you agree with that? And where is the Fed's role in any of this?
Look, I think that a lot of the supply, a lot of the productivity gains that folks are expecting from AI, I think are probably a little bit overstated. I think that the way that he danced around Nick Timiraos's question, specifically about the difference between the inflation pressures from the AI infrastructure build out and any potential disinflationary forces that come from those efficiency gains from the implementation of AI speak volumes. He did not want to necessarily answer the question directly because to do so would require him to get even more hawkish in a moment where he is tying American prosperity to this idea of AI implementation, which he said is even a shorthand for American innovation. So it's something that he's trying to handle really delicately. And because of that, I think that we're not going to get anything on the Fed policy front tied to AI.
All right. Stuart Paul, Bloomberg Economics, U.S. and Canada economist, and Andrew Szczurowski, Strategic Income Portfolio Manager at Morgan Stanley Investment Management. Thank you both for joining us on this Fed Day.
Stick with us. More straight ahead on Bloomberg Businessweek.
This is Bloomberg Businessweek Daily. I'm Emily Grafeo on this Fed Day with stocks falling as traders see a Fed hike by October. Coming up, Deborah Weinswig, CEO of Coresight Research, is next.
It's 4:21 on Wall Street. We do check markets all day long here at Bloomberg. Down Wednesday, a Fed Wednesday. The Dow, the S&P, NASDAQ all wrap things up in the red today. Just about the worst level of the day on the S&P 500 index. The 10-year, 4.48% with the 2-year, 4.19%. The 30-year, 4.92%. Traders sending stocks lower as short-dated bond yields climbed after the Fed signaled the possibility of higher rates as it assesses the impacts of the Iran war. And right now we had the S&P 500 index again at the close, 7420, down 91, drop there of 1.2%. The Dow lower by 1%. Dow Industrials retreating from a record, down 507 points. NASDAQ down 354, a drop there of just about 1.3%. The NASDAQ 100 index down 1%. The Bloomberg Mag 7 index down 2.8%. The SOX, the Philadelphia Stock Exchange Semiconductor Index, however, had an update, gaining 1.4%. Again, the 10-year, 4.48%. Spot gold down $65 the ounce, down 1.5%. West Texas Intermediate crude, $75.89 a barrel, down 0.2%. Barrel of Brent, $78.81, down today by just about 0.2%. Oil majors all lower today. ExxonMobil down 0.8%. Chevron down 1.4%. ConocoPhillips declined by 0.1%. Day 4 of trading for SpaceX and lower for the first time since its IPO. SpaceX shares fell 5%, erasing a gain that had reached 6% earlier in the session. Recapping, S&P down 1.2%, the 10-year 4.48%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Thanks so much, Charlie. Oh my goodness, it feels like that SpaceX IPO was a million years ago. That was just last week. It's fine. Yeah. It's fine. We're doing fine. All right, welcome back. Christina Ruffini here with Emily Grafea. Tim and Carol are on assignment. You heard Charlie just talking about semiconductors. Warsh was talking about AI. We are always talking about AI. You can't not these days. So the CEO for semiconductor company ASML, Christophe Forquet, says the U.S. is the global winner in the AI race over China. Forquet spoke with Bloomberg's Tom McKenzie on the sidelines of the VivaTech conference in Paris.
If we compare how we do on the entire ecosystem versus the US and China, I think today the US is a clear winner. I mean, they are looking at champion across the entire AI semi-ecosystem. I think the one place they were missing a bit out was manufacturing, and I think they have been extremely aggressive in bringing some key company to manufacture in the US. They can do that because they buy chips. 80% of the advanced chips manufacturer worldwide is bought by the United States. So I think the US is doing very, very well. China has been investing also across the entire ecosystem. I think most probably they do very well on the application side, a bit less on what's before that, but I think they are driving the use of AI most probably more aggressively than any other country.
And that was Christophe Forquet from ASML, CEO for the semiconductor company there. All right, we're going to pivot a bit because after stronger jobs data and sticky inflation concerns, economists are now dialing back expectations for Fed rate cuts this year, meaning consumers might be stuck a little bit longer with those expensive credit cards, higher borrowing costs, and less room for discretionary spending. Joining us now is Deborah Weinswig. She's CEO of Coresight Research Group. Deborah, what does a no relief rate environment mean for retail demand, discretionary spending, and just the consumer economy?
I mean, it's definitely something that's concerning right now. And we are starting to see the consumer change some of their, let's say, highly discretionary habits. And if they don't get that relief this year, we think that could even accelerate from here as there are concerns over some of the kind of, call it day-to-day, week-to-week, right, your purchases of basic necessities as consumers feel that those prices continue to inflate.
What do you, in your view, what's impacting that sentiment from consumers? Why are they feeling this way in this current environment?
If I think it still goes back to gas prices, right? They still feel that they're higher year over year. And so I think that's a piece of it. It is interesting. We've done a lot of research around how consumers are thinking about tariffs, and still it's like 40.4% of them in the last week, and we survey weekly. It's still saying it's on their mind. So I think there's oil, there's tariffs, there's I think just a lot of unease. And so I think that is kind of holding them back. And then they still feel from surveys, right, that the prices that they're paying at grocery are still ticking up a bit year over year.
And this doesn't hit all kinds of retailers equally. Talk to us a little bit about what this means and what sectors really feel this kind of sticky economic consequences more than others.
That is such an interesting question right now, because coming out of earnings and then looking at our data, it does seem that the consumer is less willing in some ways. And I've covered the sector for a long time. I can't remember the last time we've seen this, that they want to shop where they shop and they want to shop how they want to shop. So we've started to see less of a trade down. So either in retail or from brand to private label, like I think they've kind of reached their maximum pain, if you will. And that may explain some of what we're seeing in terms of the spending data.
So are they just like foregoing it instead? It's like, I only buy meat at Whole Foods, and if I can't buy Whole Foods meat, I'm going to eat like cannellini beans and tofu because it's cheaper, which is actually a decision I make when prices go up.
That's exactly it. And I will say, I went back for this interview and looked at like 10 years of data, because I was so surprised when I looked at like the last 4 weeks. It is a real change. And I think the consumers, like, I've made so many sacrifices, I'm just not willing to sacrifice anymore. And some of what we're seeing, right, is if you look at 26, right, food away from home is down about 3.6%. So people are also making real changes in terms of eating at home more, entertaining less, et cetera. And so a lot of the fun, if you will, is, let's just say, that's where they're kind of decreasing their spend. And so I think when it comes to where they're shopping and what they're buying, they're less willing to make changes if they don't have to.
What does that tell us about the path of economic growth then for the rest of the year?
Well, I always feel that people can find money in the kind of cushions of their couch. And what's interesting too, right, we've got the whole, I mean, if you think about it, right, we've got three things, right? We've got AI, GLP-1, and a finicky consumer. And with GLP-1, right there, right, you've got, 1/5 of the US population who's either been on it or on it. And so people's sizes are changing, right? And so starts with apparel, then goes to footwear, and then jewelry. And so when we've talked to consumers, it is truly amazing. About 70% of them are changing 2 sizes or more. And then 50% of the total are going out and purchasing new clothing because it doesn't fit. And so that is, in their mind, a must-have. Where we're starting to see changes is more on items at the home. So hard home furniture, soft home, kind of pillows, top of bed, top of table, et cetera. And so they're making a trade-off, but it's amazing how much they seem to be aware of the trade-off they're making, and they're being incredibly kind of decisive, and they seem okay with it. And that, I think, is what's really interesting. And for holiday, I think we'll see probably stronger than expected sales of discretionary goods, apparel, footwear, accessories. But when it comes to home and maybe other durables, maybe less.
It's also really fascinating, the GLP component when you look at economics, because to your point, people think they have to buy new clothes, but a woman I'm following on Instagram, because this is how we live our lives, was just asking if anybody could teach her how to tailor, because to that point, she didn't have the money to keep buying new clothes, and she wanted to start taking them in. And this is also impacting junk food. It's impacting people are not going out and eating as much because it's not going to be worth the money if I get the giant plate and only eat this much. I mean, are people looking at this when you're in boardrooms and when you're talking about corporate, outlook for the years? Is this really that big of a factor that people are having to bring it into their planning for the next year?
So that is truly kind of if you think about what's slicing through conversations these days, I don't think that outside of, let's say, in athletic apparel and footwear, we've seen more of these conversations because what's happened is they haven't had enough of the smaller sizes. So it's actually negatively impacted sales. Wow. We're starting to see this conversation, if you will, rise to the top, one or two, as we look at planning for the back half of 26, right? Because companies are still bringing in inventory and thinking about, kind of inventory allocation. But it's interesting because they're starting to look at demand forecasting software, inventory allocation software. So it is this idea of, right, the consumer's changing at an unprecedented rate in so many ways. And so we want to make sure that we can get back in business, right? Kind of make sure that the shelves are full of what they need to be full of. But there's so much that's changing, right? We need to really lean into technology. AI is helping significantly with that. And we've started to hear this idea, it's really interesting, of like this zero inventory. So where, AI is helping a lot of, let's say, take this software to the next level and helping retailers plan better. But it is a different conversation than the one we've had in the past. And so they're really starting to rethink the amount of product, the amount of money they're spending on inventory, and they're really thinking about customer service. Right? How do we take care of this customer who's, let's just say, in some distress? How do we make sure that they're buying, and maybe tailoring is the right answer. And a lot more retailers are offering tailoring services. It's really interesting you mentioned that. And so I think we're seeing some really interesting changes, which I think are going to be very good for profitability longer term. And maybe, just some, let's say, in the near term, a lot of change, which is leading to some anxiety, is what we're seeing in the boardroom, honestly.
Deborah, just in the last minute here, there was a lot of talk in today's Fed meeting about, communication about the economy to the public, to the consumers. Do you feel like this is an environment where consumers are facing a lack of clarity and transparency on the state of, their wallets and the American economy?
I don't think there's any lack of information. But I think that there is so much information that says a different story. And that's why, going back to some of the way we're seeing the consumer behave and some of the changes are, and their perceptions of some of the numbers, right, which we look at, right, we're interviewing them on a weekly basis, right, their perceptions are not always in conduit with the actual data. And so where they're concerned is maybe where they could be less concerned, and maybe they're not as concerned in some other areas. And so I think a bit of the waves, if you will, that they're going through, I think going back to tariffs and oil and all of these, so many kind of deep topics with deep domain expertise, they're not really sure what to focus on right now. So they're controlling what they can. And I think that, anything we can do to help them understand kind of what the real kind of foundation is for the economy, I think that's what they need.
All right. Deborah Weinswig, CEO of Coresight Research. Thank you so much for joining us. We really appreciate it. Do you get things tailored or do you buy new things?
I will mend things to avoid buying new things. So I think that was a very interesting point. I hadn't thought of that, but just about how retailers potentially might see their sales drop because, people don't want to pull back from clothes, or they'll see the sales increase if people have to suddenly buy a smaller size because they're on GLP-1s. Certainly a trend to watch.
Retail, man, I'm glad. Journalism isn't very stable right now, but retail seems very tricky to me. All right, stick with us. We'll have lots more ahead. This is Bloomberg Businessweek Daily.
It's 4:40 on Wall Street. We do check markets all day long here at Bloomberg. The Dow, the S&P, NASDAQ 100 index, all sold off today. We've got the 10-year currently yielding 4.48%. Fed Wednesday, the 2-year 4.18%, and the 30-year 4.92%. Traders sending stocks lower as short-dated bond yields climbed after the Fed signaled the possibility of higher rates as it assesses the impacts of the Iran war on inflation. S&P today at 75. 5420, down 1.2%. The Dow back below 52,000, retreating further from a record, down 507, down by 1%. Nasdaq Composite Index down 1.3%. The Nasdaq 100 Index down by 1%. The SOX, the Philadelphia Stock Exchange's Semiconductor Index, up by 1.4% today. The VIX now back above 18. The 10-year 4.48%. The 2-year 4.18%. Gold down 1.5%, 42.63 the ounce, while West Texas Intermediate crude down 0.5%. WTI 75.67 a barrel. Barrel of Brent 78.68, lower today by 0.4%. Now, what about Fed Chair Kevin Warsh? His first news conference today, and any potential conversations about rate cuts over the two-day Fed meeting. Stuart Paul is economist with Bloomberg Economics, and he was a guest right here on Bloomberg Businessweek Daily.
Anytime he brought up the remit from Congress, he did not bring up a dual mandate. He focused entirely on price stability. So I don't think that any of the discussion around the table by anyone with regard to cuts was being encouraged by Kevin Warsh today. I think that we saw pretty vintage Kevin Warsh behind the podium, and I imagine that he was the same way in the room.
Stuart Paul, U.S. and Canada economist at Bloomberg Economics, interviewed right here on Bloomberg Businessweek Daily. Day 4 of trading for SpaceX, lower for the first time since its IPO. SpaceX today down by 5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Thank you, Charlie. Well, last year, President Trump signed 4 executive orders aimed at bolstering the nuclear energy industry in the United States, including one telling the Department of Energy to approve at least 3 reactors by July 4th, 2026. Yes, this year. The Department of Energy has also altered or removed some of the regulatory framework around the industry to expedite the build-out of new next-gen reactors, which has raised some questions about safety. And it's at a time when the U.S. and the world are, of course, drastically increasing energy needs to power AI. Joining us now to talk about this is U.S. Nuclear Regulatory Commission Chairman Nieh. Chairman, thank you for joining us.
Chairman, can you hear us okay? All right, we've got just a minute. We're going to check in. It's a really interesting time for nuclear because it's not something that you can just build, right? I mean, data centers are one thing. Building a nuclear reactor is another thing. And there is a lot of regulation around that, partly because after, the 3 Mile Island thing happened in Long Island? I think so. Someone will check me. Anyway, they put in all this framework with the Department of Energy and the Nuclear Regulatory Commission, and it's been a bit of a split between those two agencies as to who is in charge of what. And some of this restructuring has shifted some of that oversight into the Department of Energy, but they've trimmed down. Now, the Trump administration says that that's an effort to streamline it because it is so stifling. These new startups can't get these reactors online. But people get a bit nervous when you start saying we're removing, regulatory framework around nuclear.
Of course. I think it's still a scary word to a lot of people. And it does seem like the market is actually still split on whether it's clean energy or not, or green energy. Some people actually see nuclear as like the solution for the energy, lack of supply in the U.S. And others think that the radioactive waste, for example, is a huge kind of obstacle here to expanding the industry.
I think what we've learned as we look, at alternative energy sources is there is no perfect solution, right? So there's always some bad with the good, even when it comes to things like wind and solar. Obviously, we have a president who despises wind because he thinks they're an eyesore and he doesn't like to look at them. And they do cause some damage to some birds and other, natural resources. Solar is the same. If you're going to panel an entire football field with solar panels, that's also not the most natural way to do things, but are they more or less environmentally impactful than some of the other more traditional? Most people would say less. Nuclear, to your point, is really kind of quite in the middle because there's also the risk factor of what happens. Look, I spent a lot of time covering the war in Ukraine. Mm-hmm. Chernobyl is still something that's very much on the minds of people there. Yeah. You had Russia coming in to Zaporizhia, that nuclear facility there, and it just heightens the risk factor of everything, of strikes, of troops on the ground, who's controlling it, who's inspecting it, who's making sure that everything is more complicated when there's a nuclear reactor involved.
I don't want to, tout my own reporting, Christina.
Yes, ma'am. Have at it. Tout away.
I actually just published a story about 2 days ago about Nuveen's private head of fixed income.
Okay.
And the story is all about how she sees a huge opportunity in investing in energy credits specifically. She's saying regardless of the AI build-out needs, there is demand worldwide for energy, basically, point blank. And so this is her quote: regardless of data center growth, there's growing demand for energy in the US, the developed world, and the developing world. She manages a $75 billion investment grade portfolio over at Nuveen. And it was interesting because I went into the interview with her thinking we were going to talk all about data centers and AI.
Yeah.
And she was saying, actually, we can't even get all the data centers that we need if we don't invest in the actual energy infrastructure. I didn't ask her specifically about nuclear, but I would be interested in, how much of that energy build out, how much of the AI build out is going to be powered by nuclear.
That's right. I think we have the chairman back. Chairman Nieh, can you hear us?
Yes, I can hear you.
Oh, great. Thank you so much. I know you had a big event at the White House today. I wanted to ask you, has there been any progress in the effort to get these big nuclear projects going? I know they were supposed to be at least 3 by July 4th, 2026. That's coming up pretty soon. And then hopefully 10 big reactors under construction by 2030. But so far, we haven't seen any actual tangible announcements. Can you give us a status update?
Sure, I can. So there absolutely has been major progress being made since President Trump issued his nuclear executive orders just a year ago last month. As you have heard, the Department of Energy has announced a criticality with one of their 11 reactors going through the pilot project, which is a very big milestone in terms of reactor development. What the Nuclear Regulatory Commission is doing as the nation's nuclear safety regulator, we are preparing the licensing frameworks for applications for commercial deployment. So today I was at the White House here in support of an event that the Department of Energy is sponsoring to uprate the power output of America's existing nuclear reactors, and the NRC has a very critical role in doing that, and we are doing that to ensure that we're going to provide credible, predictable, and timely safety decisions so that we do not delay America's existing nuclear power plants in being upgraded to really meet America's urgent demand for electricity. So over the past 12 months, the NRC has taken some major steps to reform its licensing frameworks and how it conducts its safety regulatory reviews. We have actually renewed the operating licenses for 18 of the operating power reactors in the United States so they can continue operating for another 20 additional years. And we're expecting to receive more applications to increase the power outputs of the nation's reactors over the coming years.
I want to talk to you about those upgrades first. So you're saying the power upgrades could add about 2.5 gigawatts of capacity by 2027 and about 5 by 2029. But you said the regulatory environment is increasingly central to the story. So does that mean that you are taking away regulations or lessening them to make that happen? How are you making this happen? And are you concerned that by streamlining some of those regulations, you might be taking away safety guardrails?
Just to be clear, the NRC is not lowering its standards for safety. We are actually increasing our focus on safety by really looking at what matters most when we do our licensing activities. So we're introducing efficiencies in our internal workflows. We're introducing greater mechanisms for accountability and how the federal government manages its resources and oversees its work. So the NRC remains a strong regulator, and we continue to do so even in light of all the activity here, because it is important that we continue to deliver our safety decisions in a way that's credible.
Chairman, what regulations did you need to streamline?
So there are a lot of regulations in how the United States government oversees and licenses the reactors in this country. There's huge volumes of regulations, and we're taking a very close look at all of those regulations, because many of these regulations were put in place nearly 70 years ago when we knew much less about these reactor technologies than we know today. So there were conservatisms that were included in these regulations that are no longer needed today based on the increased state of knowledge and the high levels of safety performance that exists in these facilities, as well as the ones that are being designed.
Can you give us an example, though, of one particular regulation that you have removed because you thought it was overly arduous?
So right now we have not published all the draft regulations in the ones that we're updating here. But what I will say is that we did just publish a brand new licensing framework this past March that provides a licensing approach for any type of reactor that can be licensed in the United States. So the current regulations were really designed for the large reactors that are operating today. They are really not fit for purpose for the new technologies that are being designed. So just in the last March, we introduced a technology-neutral licensing framework to provide a safety-focused review that can be done more efficiently.
Chairman, there's been a lot of pushback from Americans on the build-out of data centers to power artificial intelligence. It's an issue I'm hearing that's going to be coming up during midterms. It's becoming increasingly more political. Do you anticipate that being an obstacle here to the build-out of nuclear in the U.S., the NIMBYism, essentially?
Yeah, it's a great question. So as America's nuclear safety regulator, we don't really have any input into whether a data center is going to be deployed in any location in the United States. What our role is, however, is when an application for a reactor license to power a potential data center comes to the NRC, we are responsible for doing a rigorous safety review on time, on schedule, so we do not introduce any unnecessary delays in deploying the power. But as far as the decision to go forward with a data center, the NRC has no role in that.
I mean, nuclear fusion and reactor technology has evolved, but the fundamentals of it haven't changed all that much at the larger sites anyway. You've got closed reactors, you've got open reactors, you've got light water, you've got heavy water reactors. Can you explain how these next-gen reactors work, how big they are in comparison to what we're used to seeing or thinking about? You know, we all think of Little Simpsons, giant concrete, cascade coffins over these reactors. Is that what we're talking about here, or is this something completely different?
We are talking about so many different designs. Today's fleet of 94 operating reactors are what you can consider large light water reactors. These were technologies that were developed in the 1950s and 60s and brought to America's grid through the 70s and 80s. The reactors that are being looked at today are much different than that. They use coolants that are not light water. They use other types of coolants such as high temperature gas or molten salt. They come in different sizes, large, medium, small, and even micro reactors. And when you think about a large reactor, think a gigawatt, right? There's small modular reactors that are roughly around 100 or so, a few hundred megawatts. Then you have these micro reactors that are far below 100 megawatts. So there's so many different types of designs. The other unique feature about these new technologies is the fuel itself. These advanced reactors are using different fuel types, using different manufacturing processes to create these fuels. And all of these reactors that are being developed now use what is called passive safety features, so that you don't have to rely on very specialized systems or components to respond to any type of event in the reactor. And the fuel themselves are actually much more tolerant of severe conditions in case something happens inside the reactor.
All right, Chairman Oni, thank you so much, and we look forward to seeing those regulations. Hopefully you guys will be making them public soon. Thanks so much. All right, we're going to go to Isabel next, who has some important... Are we moving? What are we doing? We're stock moving?
We are moving, Christina. It's, time for stocks on the move, actually.
Isabel Lee, what are your favorite movers and shakers as we reach the end of our day here? I was trying, a lot of times we do the simulcast on this show, and I was looking earlier. We didn't have to do it today because I'm terrible at it, so I'm glad we didn't. But there's some interesting moves that I wouldn't think would be going the direction they have been going today.
I don't think you're terrible at it, first and foremost. Emily and I have done it, and it's tricky. But moving on.
It's very intimidating. All right,
yes,
all right.
The biggest shaker, of course, is SpaceX. I think everyone wants to talk about this. And shares declined for the first time since its record IPO, so it snapped a 3-day winning streak. In those 3 days, it gained as much as 50%, and now we saw a pullback just 5%. But still, of course, it's SpaceX. They're snapping a 3-day winning streak.
Was that inevitable, though? I mean...
Exactly. It's a volatile session, and earlier today we saw the stock pop 6%, so sure, we have a pullback of 5%. To your point, we do have a manager quoted in the story saying it's not that big of a deal. I would be more surprised and more panicky, of course, if it was a bigger drop. But, I guess the big thing is the decline made them fall back below Amazon's market cap. So, yesterday everyone was making a big deal about how SpaceX is above Amazon and briefly Microsoft, and now it's below Amazon. But it's just the 6th largest company, just 6. It's not a big deal.
Just like casual. They're going to be fine. I feel like they're going to be fine.
And again, one important point though, I mean, we know that the shares available to trade is a small portion because of the float and all that weedy thing. So that's probably why. It's not like all of SpaceX, all of its nearly $3 trillion market cap can be traded. So that's also one thing. Ticker is SPCX before anyone screams at us. It's SPCX.
What else you got?
CarMax. Ticker KMX. Shares dropped nearly 9% after its same-store sales and used car profit declined for a 4th straight quarter. So this raised a lot of questions about the durability of its turnaround effort. The stock has gained 35% this year, though, but it's still down around 2/3 since its 2021 high. So it was big during the pandemic. Remember the meme stock era? So it was one of them.
That's really interesting to me because I know we're in New York now where people don't have cars, but like
I'm one of them.
I don't either, but I did, and I did buy a car at CarMax, and everyone I knew had purchased a car at CarMax. Yes,
through the car vending machine.
No, that's Carvana.
Oh, that's Wait, how do you feel now that you don't have a car?
I miss my car. I don't miss trying to park my car, but I do miss just being able to jump in the car and leave the city. However, I'm subwaying. It's okay.
Yeah, I actually rented a car this weekend, and it was very expensive.
Oh, really?
Yeah, it wasn't, it's not as easy as just rent a car. Like, it was a pretty large check.
But used cars are still very expensive.
Yeah, exactly.
Which I wonder if this is why CarMax is struggling a little bit, because people are holding on to the cars that they've got. They're not buying new used at the moment.
That's why I stick to my $2.90 one-way metro fee.
It is a good deal. It is a good deal.
Okay, one more stock.
I'm excited about this. Ticker is a bird. It's SmartBird. It used to be Allbirds. And just for the two of you,
this is Allbirds.
I wore my Allbirds sneakers. Our listeners cannot see it. It's a ballet flat. That's Allbirds. I love it.
It's a glorious ballet flat.
I really like it. I have it in 2 colors. So when I saw that they rebranded in SmartBirds, I was like, what? Anyway, so the stock rallied 47%. They were formerly known as Allbirds, as I've said 15 times. This is the biggest intraday gain since April 15. So we all know it's a shoemaker turned AI firm. I mean, who has not turned into an AI firm? They also made an announcement that they appointed Nadia Carlson as their president and CEO and Lily Yan Hughes as the board chair. So SmartBird now, I guess, is struggling just like many other companies, and they're trying to capitalize on the AI frenzy, trying to, remember in the .com, everyone wanted a .com in their name. I'm not saying that this is what they're doing. I'm sure they thought about it well, but it's hard to ignore that. I mean, the hot thing right now is AI, and they're trying to be AI.
This one confuses me a little bit because we are starting to see a cooling off on AI investment in places where the software side is not as essential as other places, right? Like, Mandeep Singh introduced me to the phrase disintermediation. But basically, if they can pull you out easily, that's going to impact your stock. So if you're not crucial, it's not maybe, I know it's buzzy and exciting, but maybe not the best way to pivot your company. So like, what are they providing that other non-shoe brand turned AI companies are providing?
I think it remains to be seen, but for now, investors are probably celebrating. That's why you see shares gaining 50%, which is double digits. Yeah. I know. So now, I don't know, what am I going to call my shoes now when someone asks, you have nice shoes?
You can just call them cute. Just say, thank you, they're cute.
They're AI. They're AI shoes. That's Isabel Lee, cross-asset reporter with Bloomberg News. Thank you for joining us today. And for more conversations like this, listen to our new Stock Movers podcast. Subscribe for 5-minute episodes on the biggest winners and losers in the stock market. Listen to Stock Movers on Apple, Spotify, or anywhere you get your podcasts. Christina, we're almost done.
We got a minute left.
On this Fed Day.
This was exciting. I've done like one other Fed Day here since I came to Bloomberg, but this was my first one where I felt like I actually knew what was going on.
Okay.
And it is, I know it's like a Super Bowl around here. It is a little bit exciting.
I think this is also my first Fed Day anchoring Bloomberg Businessweek Daily. So that was quite exciting. I've done a lot of Fed days where I'm, on the Bloomberg side, writing the Top Live blog, but this was the first time we actually got to speak to guests, and it was great.
And we do have some really smart, amazing colleagues. Mike McKee was in the room asking, the questions that we all had, and our colleagues on the Live blog, if you've got Bloomberg, whenever there's big markets news, click on it. They basically tell you everything you need to know.
That's right.
That does it for us on Bloomberg Businessweek Daily. I'm Christina Ruffini here, of course, with Emily Graffeo. Balance of Power starts right now.